Welcome back to Millionaire Mortgage Secrets. In today's video, I'm going to run through a very simple explanation of why it's incredibly important that you use the offset account instead of repaying your loan ahead of schedule. If you have any plans or ambitions to buy a new property at some point in the future, we never know what our future plans are going to be, but if you have any plans of buying a property in the future and potentially retaining your existing property as an investment property. This is a very common strategy. If you've bought good real estate along the way, it just doesn't make any sense to buy it and flog it and buy a new house and then try to replace the one that you bought years and years ago with something later on down the track, because you're never going to be able to replace high quality property at the price that you paid for it years and years ago. It just doesn't work like that, okay? So holding on to your property as you go is a valid strategy, it's a good strategy, it's easy. So let's dive in, this is how it works. So let's imagine that you buy a property today and you pay $1 million for it, or rather you pay $1.25 million for it and your loan's $1 million. You go about repaying the loan. All you need to repay each and every month contractually is the minimum monthly repayment. Okay, so all you got to do, minimum repayment, minimum repayment, minimum repayment. Okay, now if you read my book, I say don't do this. I say make extra repayments or contribute aggressively into the offset account. So here's where the offset comes in. All of your savings, all of your income, everything that you've got is being aggressively piled up in the offset account. All right, so the purpose is to grow the offset account. I've explained in previous videos how the offset account works, so I'm not going to go into that in this video. Fast forward 15 years. So this is when maybe your family's grown, you've created a household. Now you want to buy a new home to live in. This one here is going to convert into an investment property. So that's no longer owner-occupied. That's an investment. This is owner-occupied. Now, let's just say this thing over here is, I don't know, $2 million, okay? And you have accumulated in 15 years, let's say you've put 700 grand in there, in the offset account. Now, is that offset account part of the loan? No, it's not. The offset account is a completely separate account for all intents and purposes. When you refinance from one bank to another, or you sell the home, that offset account still remains. It's just a debit account, that's all, or a savings account, depending on the bank. Same. The difference is, over here, is instead of making extra repayments into that loan and reducing the loan balance, instead of doing that, you have aggressively increased the amount of cash savings that you have over here. When you buy this new home, where are you going to get the deposit from? Instead of using, redraw or redrawing or refinancing and creating another loan over here, all you're going to do is you're going to transport all these funds that have been accumulated in the offset account, and you're going to just contribute that to the purchase of the new property. So that 700 grand is the deposit, the equity contribution for the purchase of that new home. What happens then? This loan, right, you would have been borrowing 1.6 million bucks or whatever the case may be, which is 80% against this. You've got 700 grand coming over here in cash, and then you're going to borrow the remainder after all costs. Okay, so that's the first part, is you're just using these cash savings that you've accumulated in the offset account for the deposit and costs for this property over here. What people do, if they don't do this, or they get too far along, I see it all the fucking time and it drives me nuts, because they haven't spoken to anyone who is trying to help them or is thinking ahead. With all of my clients, I'm like, hey, do you have, particularly first home buyers, and particularly when they're a young couple earning good money, do you have any future plans of keeping this property as an investment property and buying a new home? Yeah, maybe. If it's just a maybe, then put all your money in the offset account. If it's like a definite hard no, we are absolutely no way categorically going to keep this property as an investment property. I don't know why you wouldn't, or wouldn't at least want to have that option, but some people say that, not a lot of people. So the opposite to doing this, right? Remember, there's a reason for doing this, and I'm going to come to it right now. The reason why you do this is because instead of repaying this loan, right? So if you repay this loan, you put this 700 grand in the loan account itself, and you repay this loan down to, say, 300,000. These maths aren't going to be exactly accurate because they just aren't. That's how it works. So you got 300 grand that you've repaid this loan down to. You're like, shit, well, you've done that, and that's fantastic. Your equity, your savings, same thing, cash, that's in the property. It's in the property. You might have a large differential between what the loan limit is and the loan balance, but the thing is, in order to use that equity that you've got in here, you have to either refinance and create a new loan against this property, or you have to redraw all of the prepayment that you've made into that loan. Here's the thing, right? If you do this over here, so if you put all your money in the offset account, and then you use that for the deposit and costs of the purchase of the new property, you are going to be maximising, so you're maximising the loan, you're going to be maximising the tax deductible debt on this existing property. How are you going to be doing that? Well, you haven't repaid the loan balance right down to 300 grand. You haven't done that, right? So you may have repaid the loan down to, shit, I don't know, you may have repaid it down to, say, 650,000. So you've just repaid it down to 650,000, right? That's the loan, that's the scheduled loan balance based on the minimum monthly repayment, which is really all you want to make because you're putting all your savings in here. Why is that important? Because you want to maximise the future tax deductibility of this debt. Maximise the future tax deductibility of this debt. You can't do that. You're not maximising it if you've repaid the loan down to 300,000 and then you're redrawing that money out and you're putting that money into here. That's a very, very different thing from taking the money from the offset account, which is cash, and contributing it over here. So redrawing that money, you've paid the loan down to 300 grand, right? And then you're redrawing it, so you're actually increasing the loan again back up to the loan limit at that time, and then you're using it to purchase an owner-occupied property. And you say, but Brody, I'm doing the same thing, I've paid it down, I'm just going to take the money out of the redraw. Everyone calls it redraw, I don't know why, but I'm just going to take the money out of, like I'm just going to redraw it and use that for the, to put all that money in here. And then I can claim the interest on that 650,000. You can't, because the way the tax office determines the tax deductibility of debt, it's based on the purpose of the debt, not the security or collateral in layman's terms, right? The house is the collateral, the security for the loan. So I'm going to repeat that again. The ATO determines the tax deductibility of the debt based on the purpose, not based on the security. Now, why is that important? That's important because you need to understand that if you repay your loan down to $300,000, because this is what you want to be doing, then you redraw that money out, okay, you're redrawing a prepayment, right? That money, that new debt that's created because you're taking this loan back up to $650,000, that $350,000 is not tax deductible. You cannot claim the interest on that new loan that you've created because it's new debt. You've repaid it down to 300 grand, now you're taking it back up to 650,000. You can't deduct that, so don't do this, right? The smart way to do it is to accumulate all your savings in the offset account. This is still as effective as it can possibly be, and if you're with 98% of banks, your repayment doesn't change either. So you are actually making pretty solid repayments on your loan. It's just you are maintaining, you're maximising the amount of cash that you have available to contribute towards this future purchase. Therefore, you're minimising the amount of non-income generating, non-tax deductible debt. So the more equity, the more cash you're contributing towards the purchase, you're minimising the amount of non-income generating, non-tax deductible debt. And if you are doing this strategy here and you're not repaying the loan, then you are also going to be maximising the amount of income generating tax deductible debt. Now, there's two important reasons, that's four. There's two important reasons why you want to do this. The first one is you are minimising the amount of debt over on your home. That means you're going to repay that home, you're going to own it faster. Okay, so less debt, quicker to repay, soon you're out of debt, debt's gone, you're living in your own home, bye-bye bank, you get the title back, put it in your knicker drawer, happy days. Now, why do you want to maintain a high level of tax deductible debt on the investment property? It's going to increase the amount of tax refund potentially that you're going to get. Say potentially because I can't say for sure, but it's going to increase the amount of tax refund that you're likely to get, and it's going to therefore reduce the amount of tax that you're going to pay. So you're going to keep more of your money that you've earned in your back pocket, i.e. the tax man is helping you to own this property and create wealth and financial security. Okay, you follow me on that? It's not the easiest concept to get, but I hope I've explained it reasonably clearly. Just do this. If you have any plans, even if it's just a little crumb of an idea, right, a little kernel. If you have any plans to buy another property at some point in the future that you're going to live in and retain your existing property as an investment property, do not make extra repayments into that loan. Accumulate your money aggressively in the offset account. That offset account, that is savings, is totally separate from this loan for all intents and purposes and tax reasons, and you're going to use that for the deposit and costs for the purchase of this new property, and you're going to minimise the amount of debt that you have on your home, which is always the goal. You're going to maximise the amount of income generating tax deductible debt that you have on this property over here. So I have delved into the cash flow, the P&L of an investment property and how this works on another video, so I'm not going to do that now. Thanks very much for watching. Remember to like and subscribe to the channel. Thanks again.